Hello, agents. Today we're diving deep into two major proposals in the news today: the removal of minimum credit scores for Fannie Mae loans, and the proposal of portable mortgages. Let's start with Fannie Mae. For decades, a minimum credit score, typically 640, has been a requirement for conventional mortgages backed by Fannie Mae. This standard aimed to ensure borrowers met a baseline of financial reliability. However, this approach has faced scrutiny for potentially excluding creditworthy individuals with thin credit files or non-traditional financial histories. The proposed change, starting on November 16, 2025, aims to dismantle this rigid requirement. Instead of a single score, lenders would be encouraged to adopt a more holistic view of a borrower's financial health. This shift is designed to broaden access to home ownership, particularly for those who have demonstrated consistent payment behavior on rent, utilities, and other recurring bills, but haven't accumulated a lengthy credit history. Without a hard credit score cutoff, the underwriting process would become more complicated. Lenders would leverage alternative data points, such as payment histories for rent, utilities, and even phone bills. Tools like VantageScore, which can incorporate a wider array of financial data, would gain prominence. This approach seeks to identify strong borrowers who might otherwise be overlooked by traditional credit models. The rationale is compelling. Many individuals consistently pay their bills on time, yet their financial footprint doesn't translate into a high FICO score. This could include young professionals, recent immigrants, or those who prefer to avoid credit cards. By considering these alternative indicators, the goal is to qualify a broader segment of the population, fostering greater equity in the housing market. For homeowners, this could mean a larger pool of potential buyers for their properties, which could increase the demand for homes and prices. While the intent behind removing minimum credit scores is noteworthy, the practical implementation is almost impossible. Even if Fannie Mae removes its internal FICO score requirements, the secondary mortgage market operates differently. Investors who purchase mortgage-backed securities impose their own credit score thresholds to mitigate risk. This could cause a problem. Lenders follow Fannie Mae's rules when they give out loans, but they still need to sell those loans to investors. If investors still want to see FICO credit scores, but Fannie Mae no longer requires them, lenders might get stuck. They'd have loans that meet Fannie Mae's new rules, but that investors don't want to purchase. So even if the rules change, lenders might still have to follow the old ones and require FICO scores to keep selling loans and managing their risk. So this move by Fannie Mae is largely symbolic and won't change the way loans are originated. Now let's talk about mortgage portability. Imagine being able to transfer your existing mortgage, with its favorable interest rate, to a new home. This is the essence of mortgage portability, or porting. For example, if you secured a 3% interest rate on your current home, you could potentially carry that rate over to a more expensive property, only taking out a new loan for the difference. This concept has gained traction as a potential solution to the locked-in effect, where homeowners with low rates are reluctant to sell, contributing to a stagnant housing supply. For homeowners, the benefits are clear. It could unlock mobility, allowing them to move for work, family, or lifestyle changes without sacrificing their historically low interest rates. This could inject much-needed inventory into the market, potentially easing supply constraints and offering more choices for first-time buyers. It's a policy designed to stimulate transactions in a market currently hampered by high rates and limited listings. While appealing to homeowners, portable mortgages present a fundamental challenge to the traditional banking model. Banks and investors typically underwrite mortgages with the expectation that loans will be paid off or refinanced within an average of 12 to 13 years. This early payoff allows lenders to recycle capital and avoid holding low-yield assets for decades. But if mortgages could follow borrowers forever, it would change how things work. Lenders might get stuck with loans that have super low interest rates for decades, which could hurt their finances. Kind of like what happened during the Silicon Valley Bank crisis. Back then, banks lost money because they were holding on to long-term loans that didn't pay much while interest rates were going up. To deal with this kind of risk, lenders might raise rates on new loans on a market that already have high interest rates, in turn making it more difficult to afford a home, or they might ask the government for help passing the cost to taxpayers. Both the credit score adjustments and mortgage portability proposals primarily address the demand side of the housing equation. They aim to make it easier for people to qualify for loans or to move more freely. However, a critical analytical perspective reveals that the core problem in many housing markets remains a fundamental lack of supply. Without significant increases in housing construction and reforms to restrictive zoning laws, affordability challenges will persist. Policies that merely reshuffle loan structures or expand access without addressing the underlying supply deficit may offer temporary relief, but fail to provide a durable solution. Long-term affordability and market stability hinge on building more homes to meet growing demand. These proposed changes are not just headlines. They could directly impact your ability to buy, sell, or refinance your home. Understanding the nuances of these policies, their intended benefits, and their potential risks is crucial for making informed financial decisions. I will keep an eye on these proposals and continue informing on them. Make sure to subscribe to my training website and don't forget to leave a comment.